Hey, we are live. It is 2 p.m. on the Eastern Seaboard here in the United States. We're live for the Let's Talk Money live stream. Every week I try to do these, and really it's just a great way to talk about what we talked about in the week's videos, answer your questions, and just really be part of that community. And I'm loving the interaction that we get, and evidently there's a lot of people out there that are too. We're approaching 28,000 people in the Let's Talk Money community, so I welcome everybody. You know, if you care about beating debt, making more money, and just making your money work for you, then click that little red subscribe button. And we're here Mondays, Wednesdays, and Fridays, and usually these live streams on Saturday. Now today's video is going to be a special video, though. I promised a few of the people in the community that asked for it to go over some of the investing jargon, investing ideas in a video, as well as some of the market, some of the ways to value stocks and investments that I used as an equity analyst and in private wealth management. So this week we're going to do just that. We're going to get into mostly the investing terminology that you need to know. But we're going to go beyond that. It's not just going to be a bunch of definitions. It's going to be how to actually use these ideas and these terms to create your own portfolio and to really make investing easy, because that's what it's really all about, right? Is meeting your financial goals without having to be a full-time investor or be tuned into CNBC all the time. So that's what we're going to get to. I do want to point out yesterday's video. If you haven't seen it yet, check it out after the live stream here. It's a great video. I discussed 7 investments, 7 different types of investments and assets you can make, and it's really a 2019 outlook. This is really what I used to do when I worked in private wealth management. Is every year about this time we'd get the team together. Each analyst would take an asset, whether it be stocks or bonds or real estate or even art. And they would put together a report, a presentation on their asset about the outlook, the risks, and expected returns for the year to come. So I put this video together, and I got to say it's a great video. It's one of the first fastest to 1,000 views of the videos we've had, so it's becoming really popular. So make sure you go back to the channel Let's Talk Money and check that out after the live stream. But like I said, I want to get into these investing terms. We're going to cover 15 investing terms and ideas that you need to know to really make sense of how to put together a good portfolio. I mean, because a good portfolio isn't about just picking stocks. It's that how of investing, that understanding some of these terms and how they all fit together. So we're going to get right into it. And the first one we're going to talk over is asset allocation. Now, a lot of these terms are going to be kind of basic, going to seem kind of basic, but we're going to go into how to use them all the way from a beginner even to advanced investors, how to put them together, and really how to make it free book. Yeah, I don't know, what's that? He's asking for a free. Oh, hey, Burn Taco, how are you? But yeah, we're going to get right into these 15 investor terminologies. Okay, so assets is really the most basic, and this is just, an asset is a group of investments that share kind of common characteristics, how they react to the economy usually, right? So you've got stocks, you've got bonds, you've got real estate are the 3 most common, but you've also got things like art, you've got things like peer-to-peer, which is kind of bonds, but in a class all itself. And why this is important is because this is how you create that portfolio that is really going to smooth out your returns and help you not freak out during the next stock market crash, right? Because stocks react very volatile in a very volatile fashion with the economy, especially some of those cyclical stocks like technology, industrials, and materials, like what we've seen in this last October here, where the markets went into correction mode. And a lot of those sectors really fell hard, but stocks in general are going to react to the economy more, and specifically on a lot of those wages that eat into corporate profits, things like that. Well, you don't get that in things like real estate, where there's not a whole lot of wages they have to be paid out. So maybe they react a little bit more to interest rates, but not so much to other parts of the economy. So by holding these different assets, having stocks, bonds, real estate, art, P2P, some of those other investments that we talked about in yesterday's video, then some assets are going up, some assets are coming down, but it's a much smoother ride. And hey, Lydia, you meet your goals with much less stress, really. So in this next one, let's go to, oh, I just realized I'm sharing. Okay. Let's go ahead and put this on slideshow so it's a little bit easier. There we go. Okay, next is the expense ratio, and this is a very important one that most people don't realize how much this actually costs you in your investing. You'll see this mostly in funds, but it's also applicable with advisors, right? So anytime you invest in a fund, whether it's a mutual fund or an ETF, or you invest with an advisor, there's going to be a such thing as called an expense ratio. And this is just what you are charged for that service, either investing in the fund or having the advisor handle your investments for you. And typically, the average ratio for a mutual fund is going to be upwards of 1 to 1.5% a year, which means 1% of your money invested in that fund is getting taken out for management fee each year. And that might not seem like a lot, but for every $10,000 you have invested, that's $100 lost. And it's not necessarily just that money you lose that year, but all the money you could have made on that every year after that. So I share, in the lead up to the course that I have, I share one example where, starting with $10,000 in an advisor portfolio, getting that 1% expense fee every year, and then investing maybe $250 a month is actually going to end up costing you over $100,000 over 30 years. And that's because of that 1% expense fee that you lose every year, but then just on the money that you've lost making money off of that. It's actually only about $50,000 in actual expenses that you pay, which is actually kind of a lot too. But the money that you're not making on that is quite a bit larger. So it's very important to watch those expense ratios, and that's always going to be disclosed, whether it's on a mutual fund or an exchange traded fund, which are those ETFs, or by an advisor. Now, what's really dangerous is when you do talk to an advisor and they're quoting you that expense ratio of theirs, you're also going to be losing that expense ratio on any funds that they invest. So you're paying that expense ratio to the funds, plus you're paying the advisor expense just to manage your account. So always be watching for those. Generally, if you can do your investing yourself and invest in ETFs, those are generally about half the cost of mutual funds. So a much better deal there. Now we're going to talk about the price earnings ratio, and this is going to get into a little bit of what we'll talk about next week also, this way to value stocks. And I know a lot of people asked about how I valued stocks as an equity analyst, what I looked for in different stocks as a venture capital analyst and working in private wealth management. So we're going to go over some of the real basics here with this terminology, and then in our next live stream we're going to actually look further into these, into how to actually apply them and how to use them. But the price earnings ratio, this is just the one I started with here because it's really the most popular, the one you hear about from pretty much everywhere. Oh. Is it? I'm seeing that comments are saying we're offline. Somebody let me know if we are still online or if we are frozen out. Okay, so I'm seeing it's kind of frozen, kind of not. Let me try to refresh this and come back to you. Okay, so we should be good now. Sorry about that. All right, so I just started with a price earnings ratio because it's the most common valuation metric you get, and really a good lead into some of these other valuation metrics, ways to value stocks that are much more efficient, much more effective at actually finding a good price. And I understand the popularity of the price earnings ratio. It's very easy. Basically you just take the earnings reported by the company and divide it by price. So it's intuitive. Buying stocks is a call on those future earnings. So obviously you want to know how much you're paying per price. But there's a problem with it, and it's because earnings are easily manipulated and managed. If you work long enough as an analyst, you you get to kind of a game with management where they'll say their earnings are going to be something in the next quarter. You say they're going to be something, and then you kind of go back and forth, and it always ends up being either very close or maybe just they make earnings a little bit higher. They'll beat earnings. So of course you always see how, such and such company always beats earnings. Well, yeah, it's because they're managing those earnings expectations. And they're manipulating their earnings. Even more important, they're manipulating those earnings to where they meet those expectations. You can take sales earlier or later, or you can book them on your income statement. You can take a lot of expenses earlier or later. You can capitalize those expenses. So earnings are just a very generally low quality judge of the business of behind a stock. So what I like to look better at, and we'll talk about these again in the next live stream. One is enterprise value to sales. Now this is one where basically the enterprise value is going to be your market capitalization, so the total value of all the shares, what investors are saying that company is worth, minus out the cash on the balance sheet, plus and then adding back all the debt. So it's basically the market capitalization plus the debt, which is, if somebody wanted to buy that company, the enterprise value, that's what they would have to pay. So market cap plus the debt minus cash, because, obviously cash can be sold off. And that over sales. Now, why this is important is because that is a true estimate of what the enterprise is worth, what your stake in the enterprise is going to be worth. And it's much harder to fudge than earnings, right? Okay, because you've got sales. Yeah, sales can be brought forward or moved back to manipulate that a little bit. But the enterprise value is what it is. That's how much investors are saying the stock is worth right now, minus those that debt and that cash. So it's a very important metric, used a lot more in venture capital because that's what companies are judging another company on to buy that company. If you want to stick with those price variables or those price multiples, you should be looking at price to sales also. Again, and that's just because sales are much less manipulated than earnings. You start with sales, and then on the income statement, you work your way down, and every little, every line item on the income statement is a new chance for management to manipulate that line item to show it better than it actually is. So if you start up at the top, that top line number of sales, price to sales gives you a purer look anyway of what's that worth. Now, saying that, you don't want to completely ignore earnings or operating profits. One thing that we'll talk about in that next live stream is how I look at operating cash or operating earnings. Okay, and so this is the company's earnings before before taxes and before interest payments, but after all those expenses. And this is important because this is really the profitability of the company. This is how well they manage from sales minus their gross expenses and then minus their operating expenses. So it's a really good metric to look at, but we'll talk about that in that next one. Then you get into like industry specific measures, and these are really good, especially for stocks like social media, for financials. You have specific measures that are really well suited for those industries. And for example, for social media, you'll have the users, your average monthly users, daily active users, things like that. And it's just a better way to look at an industry. And if you really get into looking at stocks and understanding how to value stocks, you get into this idea that Peter Lynch talked about, and it's in investing in what you know. And a lot of people kind of misinterpret that. They think, okay, investing in what I know. Why I buy Campbell's soup all the time, and I like the soup, so that's what I know. Well, no, you really don't know how that business is run just because you eat the soup. Okay, investing in what you know is really understanding how that industry operates, how that company moves from how they make sales, marketing, how they all their expenses, and all their cash flow problems specific to that industry. And so that's why so often you see either an equity analyst come from working in that industry to being an equity analyst, or an equity analyst will just cover one or two or a few industries, or maybe even a sector at the most. And it's because you really do need that deep knowledge of how that industry works and specific measurements that are applicable in that. And and I know you're sitting there, you're like, well, okay, if I only invest in stocks of companies in a specific industry, so if I only how do I feel about marijuana? Well, ask me that. We'll get back to that. We'll do Q&A all at the end of the the live stream, but that one kind of threw me a little bit. So if you're only investing in stocks from a specific industry, so like social media, and you invest in that, how do you invest in the rest of the market? Well, you invest in funds. And this is what most analysts actually do. They invest their portfolio broadly in funds or even the whole market, but then they pick stocks out of that one sector or that one industry for their extra return. And this is because they know that industry, they know how to get that alpha, they know how to get those extra returns. Not so much the rest of the market, not so much those other sectors, and so being a jack of all trades is very dangerous in investing. So that gets back to that, those ratios that we talk about. And another idea in this, pricing and valuation that we'll talk about is not necessarily that the valuation method you use, but just understanding what's priced into a stock. Okay, because you're investing in a market with millions of other investors, right? So all of those expectations, all of the current news about that stock is built into the share price, and even some of the expectations. Okay, so if it's widely expected that a company is going to come up short on earnings, that they have maybe some legal problems that they're facing, things like that, then there's a lot of investors betting on which way that's going to come out. So the idea isn't so much to what you feel about the price right now, but what do you think is built into those shares? What are other investors expecting, and why do you have a positive or negative outlook on those expectations? So if you think, in your analysis, you think that those legal troubles really don't have much merit, then that is obviously a different expectation from the market, and that is something that you can actually invest on for those short-term investments. Now, of course, fundamental investments, you go further out and invest in in stocks on a longer-term picture. So our next terminology here is bull and bear market, and you hear a lot about this lately just because of the horrible October we've just had. So I thought I would just talk about these real quickly. A bull market, very much less defined than some of the other stuff we'll talk about. It's really only the prolonged rise in prices. So a bull market is anything where prices have been going up for a year or more. Right now, bear market is much more defined, and we know that better as a market of 20% from the peak. So you take the peak over the last year, the peak in prices or the market itself, and if prices right now are down 20%, that is a bear market. And that can be in sectors, that can be in industries, that can be in the entire market. So for example, we've got a correction right now in the general market, in the S&P 500, but it's still not necessarily a bear market. Well, you look at some of the other sectors, and I actually believe industrials and materials right now are actually in a bear market because I think they're approaching that 20% from the peak part. And then finally, a correction is just 10% down, and we've talked about that, and we've seen that just in October here. So our next is diversification, and this is very important for the how of investing, and it relates to that asset allocation we talked about earlier. Everybody talks about diversification, but why does everybody avoid it? If you actually look at your portfolio right now, how much do you really have in bonds and real estate and maybe some other alternative investments? For most people, it's a very low percentage, and that is obviously that's a problem when the stock market starts to creak and tumble a little bit. It's not necessarily that you have to give up your returns, because real estate can be a very good, a very viable investment and very high returns even when the stock market is falling. So you can find other assets and other investments to get into and hold to give you that diversification. But again, that diversification, that's just as it relates to that asset allocation we talked about. It's just having some money in different assets, so having some in stocks, bonds, and real estate to kind of smooth out that ride. Now, next we'll talk about sectors and industries. Now, we've kind of talked a little bit about this in the equity analyst role, And this is just really how stocks and business is classified, right? So you've got the entire economy is split up into sectors. Okay, so you've got consumer staples, which is a lot of the things that we buy on an ongoing basis, like household materials, things like that. A lot of food processing. You've got technology, which is the whole gamut of the technological world. You've got telecom within those sectors. So those are very broad pictures of the economy. Now within each sector, you've got dozens or even hundreds of industries. And industries are something that sells a common product. Okay, so within technology, you've got the social media industry, which includes Facebook, Twitter, Pinterest, all those related businesses. So just remember, sector is bigger picture, companies that serve a common need. So consumer staples, telecom, energy, financials is a sector, and then within each sector is industries. Within the financials, for example, you have banks, you have asset managers, things like that serve a common product. Okay, and these are very important when you start looking at that diversification. Not just diversification across assets, but you want to be diversified within your assets as well. So within stocks, you might be just fine with 60 or 70% of your money in stocks, as long as it's diversified as well. As long as you don't have everything in tech stocks, right? And for a lot of people that are just invested in a passive index of the market, the S&P fund, that's 25, 30% at times of just technology. So that's not diversified at all. So it's very important to understand these different sectors of the economy, how they react to the economy, different like interest rates and wages and different drivers in the economy, and to be diversified within that as well. Okay. I went too far. Okay, correlation. Now this is a math nerd word that obviously I love because I'm a math nerd, but you don't have to be a math nerd to think about it. Okay, correlation is just the idea of how do investments move together. Okay, so you've got stocks and bonds. Do stocks go up and then bonds go up at the same time all the time? Well, no, because they're very uncorrelated with each other. Correlation technically goes from -1 to +1. And -1 is be perfectly uncorrelated. So if one investment goes up, then typically the other investment, the returns, that's what we're talking about, the returns on it go down. +1 would be just the opposite. If one investment goes up, typically the returns go up exactly the same amount. So those are the two extremes, and you rarely find something that's at those extremes. Usually it's a little bit less, maybe 0.63 or 0.4. And I want to share a site with you. This is something I talked about in a previous live stream. It's a great tool to use, so I wanted to bring it back and show you how to use it. This is the Select Sector Spiders website. So that's sectorspdr.com, sectorspider.com. And here you can find a lot of the, you can find all the sectors, the S&P 500 here with all the sectors and their performance. We'll go to year to date, so you can see how all the sectors are doing year to date, 1 year, 5 years, and really kind of get an idea of what sectors are falling behind, which ones might be overvalued, things like that. And that's great. I use that a lot in my research. But what I want to look at here is you go back up to the menu and you go to Correlation Tracker. And what's really cool here when you're planning your investments is you can click through there and you can enter any stock or fund right here. So let's say the XLF, which is the financial sector spider, all the financial companies in the S&P 500, and then you click correlate, and that's going to show you how that is correlated, or how that goes up and down along with some of these other sectors. Okay, so obviously it's perfectly correlated with itself. But then if you're looking for, for example, if you've got a portfolio that is very heavy in financials, for example, with this example, and you're kind of worried about your diversification, you want some other companies that maybe are a little less diversified and are going to protect your portfolio from those losses if those financials slip. So you do that, and you go down here and you got, okay, utilities is 0.35, which is minimally correlated. And that's obviously because, as financials jump around a little bit, then, utilities don't tend to follow the financials. Some of these are a little bit higher. So for example, if you had a portfolio that was very heavy into financials, or let's do an example that is a little bit more applicable for a lot of people, because I know a lot of people are real heavy into technology. So if you've got a very tech-heavy portfolio, then maybe you don't want to be so much in healthcare or just consumer discretionary, because those tend to rise and fall very closely with technology. And here it's because of the economy. Technology rises very quickly with the economy, and so does consumer discretionary. Now, I would say with this, healthcare is a lot because of that biotech sector or industry within healthcare. But industrials as well, materials follow technology really closely, so those would not be good candidates for your portfolio or stocks within those sectors if you were trying to get better diversification. On the other hand, these consumer staples, utilities, even energy moves less with with technology. Hey, my first I don't know what those are called, but thank you, Lydia. Those extra things, whatever. So Select Sector Spider website, very good website to use for that. Next, we'll look at market capitalization, and this is another really interesting term. It's just the total value of all the company's shares. Okay, and generally, most sites will just say market capitalization and 3-5 billion. What is interesting about this and how you can use this is investing in different size companies, because generally smaller companies are going to grow faster. They've got a little bit more flexibility, whereas larger companies might be a little bit more stable, might be a little bit better for a conservative portfolio. So generally, companies are separated by market cap. Nano cap stocks are stocks of usually about 50 billion or less, which is a very small company. To have publicly traded shares, those are usually going to be on the OTC or the Nasdaq or even the pink sheets, which I would completely avoid the pink sheets. Even if you're investing in penny stocks, avoid the pink sheets. Go with OTC and the Nasdaq stocks. Small cap stocks are going to be anywhere from that 50 million up to usually even up to 500 million or a billion a lot of times. These don't have defined definitions, but that's generally accepted ranges. Mid-cap stocks are usually going to be between 3 to 5 or 3 to 10 billion. So it's a little odd to talk about a small company is a company worth $1 billion, but that's just when you're comparing it to a $1 trillion company like Apple or Amazon, well, they are very small companies. So mid-cap is generally between that 3 billion and 10 billion mark. Large caps are then going to be between 10 billion and I think it's about 200 billion, 250 billion is the generally accepted cutoff there. And then mega cap stocks are those companies valued at 250 billion and higher. So those are obviously much fewer and very large companies. Now the yield is very important for dividend investors, for investors looking for that cash return, and it's really just the dividend that's paid out on a yearly basis divided by the stock price. And this is important because I get a lot of people on the dividend videos that I do that want to say, okay, well, is that paid every quarter, or is that the percentage you get every year or every quarter? No, the dividend percentage that you see, and this is always what you'll see as a dividend percentage, is that yearly basis. So if you're looking for what you're going to receive on every 3 months, or usually, or maybe monthly for a very limited amount of stocks, then is that divided by 4? Okay, so if you're looking for a dividend percentage, for example, if the dividend yield is 4%, you're going to get 1% every quarter, which is actually a very good dividend percentage. What is a safe dividend yield? I see a lot of people reaching for these 12 and 15% dividend yield stocks, and there's a lot of warnings with those, and we'll get to those warnings in a minute here. But I would say if you're investing in general stocks, then a safe dividend would be anywhere between maybe 2% to 6% at the most. That would be pushing it, a 6% dividend yield. And even more than that, you can look at the the payout ratio, which is just how much of their earnings they're paying out as dividends. So that's going to vary by sector and by industry, but generally, you get these dividend yields that are very high. Then you look at the earnings payout, the payout ratio, and they're paying out like 80 or 90% of their earnings as dividends. Well, what's left after that? What's left to grow the business or even just to stay competitive? And there's nothing. And that's why a lot of these companies with these very high 6, 7, 8% dividend yields are going to run into trouble because they're paying everything out as dividends and not holding anything back. Now, so when you're looking at dividends and what's a safe dividend yield and looking at some of these warnings, and it's just that you need to look at the payout ratio, how much they're paying out compared to other stocks in their sector. And it's always important to compare stocks within a sector or within the industry because that's a little bit closer to what their capability is. But also you want to look at just the price action in that stock. You'll find a lot of dividend stocks or a lot of stocks with high dividend yields, and it's only because the stock price has fallen so much. If they've got a 25 cent dividend per year on a $10 stock price, then that's what is that, 4% divided by 10? Yeah, that's 2.5%, right? Now, if that stock price falls to $5, well, it's got a 5% yield. That must be a great dividend stock. Well, no, it's only because something's wrong with the company and the stock price has come down so much. So be fearful when dividends are dividend yields are creeping up like that. And this is obviously when I say comparing dividend yields and payout ratio across sectors, you also need to do that when you're talking about BDCs, which are business development companies, REITs, which are real estate investment trusts, and then MLPs, which are master limited partnerships. Now, these are special corporate structures where they get special tax loops or special tax breaks or advantages for paying out most of their dividends. So naturally, they're going to have a higher dividend yield, but that doesn't necessarily mean that they're in trouble. So you have maybe a different range of what is a safe dividend within those different kinds of investments. Next, we're going to talk about another very important term, and not important necessarily for why you think it might be. Not important for its popularity or use, but how it can go wrong. This is dollar cost averaging. Now, dollar cost averaging just means, okay, you buy a stock for $100, and it goes down. And you're freaking out a little bit, but you still like the stock, and it's down to like $80. Well, now to get even, you have to make a 25% return on that stock just to get back up to that 100%, right? That's just how prices work, how math works, I guess. You start with 100, you lose 20% down to 80, but now you need 25% to get back up to even. But you think, hey, I'll buy the same amount of shares again at $80, so now I'm averaged out to $90, and I only need the stock to come up to 90 to break even, and it makes sense to a lot of investors, and it's a very popular strategy. The problem is where it can go terribly wrong, and I want to show you an example here of Lending Club, which isn't a bad company. I mean, it's a decent company, but you can see the problem with dollar cost averaging. So even if you missed the IPO a few years ago, it went up to 25 very quickly. Even if you said no, that's way too expensive, and I'm not investing at this point, but it came down to 20, and you bought into the shares. You think, okay, it's off the IPO price. This is a good price. So I'm in at 20. Then it starts going down. Well, you liked it at 20, you love it at 15, so you buy more. Well, crap. Now it's down to 10, and even if my average price is $17 now between that 20 and 15, that's a 70% return I need to get back up from 10 to that 17. So I buy more at 10, and then it keeps on falling. I think right now it's right around 350 is where the current stock price is. And you can see where you can just chase this stock all the way down. And I actually know a guy that got caught in the big coal sell-off a few years ago, if you remember. Coal stocks were just selling off. Natural gas was taking all their business, and some very big names in coal actually went bankrupt. And I know an investor that lost $40,000 because he followed. It was Peabody. Peabody was one of the most efficient, most well-run coal companies in the world, but just wrong time for it. And he followed that stock all the way down. Eventually, it became something like 60% of his portfolio. And that's the problem with dollar cost averaging. That's the risk, is that you follow this stock all the way down, buying more just to get even. It's almost like you start becoming a gambler because you just want to get even. And this stock becomes 50-60% of your portfolio, and you can't sell now. Now you'd be totally devastated, but until you sell, you really haven't lost anything, right? Eventually, these if you're lucky, the stock might level out for a long time, or it might bankrupt. Like this investor, the investor friend I had that was in so deeply into Peabody, it bankrupted, and that wiped out 40,000. I mean, that was most of his portfolio. So what I want to say about dollar cost averaging, it's not that you shouldn't do it, but you need to have some very defined buy points into it. Okay, so you're in a stock, you like the company, you think it can do well, but then you need to set buy points into any investment. Okay, so if it falls 10-20%, what are you going to do? If it falls another 40%, what are you going to do? Each time it's falling, you need to reevaluate whether it's a good investment, and when you are actually going to buy more into that stock. And so that's one point. Have those defined buy points so that you're not going to every $2 or $3 you're going to buy more shares. It has to be a significant change from where you've bought it before, just to dollar cost average down. But also, more importantly, you need to set an upper limit into how much you're invested in that company. And I would say for stocks, no more than 5% of your portfolio. Okay, so I know if you invest long enough, you're going to come to a stock where it's going down and you still love that company. You still think it's got great potential, and you want to invest more because you think it could be the next big thing someday. It's just having a hard time right now. But you need to limit, I'd say, to 5% in any stock, because otherwise, you're going to chase it. You're going to chase that stock all the way down, putting more and more money into it, and it's going to wipe you out someday. So let's go back to here we go. Let's go back to the terms here, and our next term is going to be, so the Fed, Federal Reserve, and Fed funds. And these are obviously very important lately because the Fed has such an influence on the economy, right? And you always get this in this late cycle part of the economy. I've been through three or four economic cycles now, and you always get this late cycle where the Fed is very important. So the Fed is just a group of bankers, government bankers that control or set the federal funds rate, right? And this is just the rate that banks pay for their overnight lending deposits, right? Now, a lot of this is very technical, and you really don't need to know the exact workings of it, but just understand that the Fed, the Federal Reserve, sets these target rates, very very short overnight rates. Well, what that does, obviously, if they're raising those rates, if banks are finding it more expensive to borrow at that overnight rate, then they have to raise their rates, their longer term rates. So it changes the rates the longer out, the 2-year, the 10-year, the 15 and the 30-year, those 30-year mortgages. So the Fed meets in the Federal Open Market Committee, right, which is just a group of these central bankers, these government officials. Some of them on that committee have voting rights, and some of them are just on the committee. And those voting rights change regularly. It's really not that important to know. And they set that benchmark rate. Well, why this is important? Because that federal funds rate affects so many pieces of the economy. It affects the interest rates, which is obviously how much it costs you to get a house or a loan. It's how much businesses pay for their own loans and their own debt. But it also affects the dollar. Higher interest rates for one currency are going to make it more expensive versus another currency. So right now, a big thing what we're seeing is the dollar is extremely strong against other currencies, especially against the euro and the yen. And that's because the Federal Reserve has been raising rates since December 2015. I think they're on something like 6 rate hikes right now. They're expected to raise again in December, and then 3 or 4 times next year. Well, the European Central Bank, the ECB, and the JCB, the Japanese Central Bank, aren't raising rates. In fact, they're still pushing money out there into the economy, trying to get economic growth going faster. Well, so if somebody can invest in a dollar asset at the higher rates, it's dollar bonds, anything denominated in dollars, rather than so I think the German Bund is still at negative interest rates. Like a 10-year German bond is still is almost negative interest rates. I think maybe it's right around 0. Why would anybody invest in that when they can get a 3.2% return on the U.S. Treasury? So you've got all this money coming in to get those higher rates, more demand for a dollar, supports the dollar, props it up, and makes those dollars more expensive. And of course, that interacts with trade and a lot of other things that affect the economy. Thank you for making these. Okay. All right. Our next one is we're going to get into some of the investing strategies here. So our first one is growth investing, and this is probably one of the 2 most popular investing strategies. We'll talk about value investing in the next one, and this is just investing in companies with faster sales or earnings growth, right? And typically here you see those valuation metrics. So price earnings, price sales are much higher, but investors rationalize it because if you're paying more now for the stock for those earnings, well, the earnings are going to be much higher in the future. And it can work. You look at Amazon over the last 10 or 15 years, has always been much more expensive on a price earnings, enterprise value, any kind of valuation metric you look at, always been much more expensive than a lot of other retailers or even a lot of other internet stocks. But that price has just kept on going. The problem with growth investing is that it can fall apart very fast. That stock is valued on those future earnings, on those expectations for future earnings. So the second that those expectations fall apart a little bit, and this is what we've seen in Facebook over the last 2 quarters. They made that huge quarterly announcement that earnings were going to be in trouble for the next 4 quarters. We've seen it in Tesla, we've seen it in Netflix this year, and as well as Apple. Is those stock prices can come down very quickly if those earnings expectations fall apart. Now with those stocks, the stock price has subsequently rebounded, but you look at other growth stories like Fitbit and GoPro, and that theme of growth investing just never came back. So here, like we talked about earlier in those valuation metrics, you really have to know the industry. And here it's more of a qualitative analysis than quantitative. Okay, so you're looking at that company's advantage. How are they going to keep that growth going beyond what those expectations are? What can they do to really keep that growth theme going? Next, we'll talk about value investing, and this is kind of the other side of the coin. This is investing based more on those valuation measures. And those price multiples. Okay, so this is a little bit more quantitatively, where you're just looking at how much is this stock priced at versus its sales or versus its earnings or other valuation metrics versus these other peers. And again, it's always important to compare these stocks with their peers. You don't compare Amazon with Bank of America, because they're in completely different business models, and the stock is going to be valued completely differently. So you always want to compare within an industry to find those best of breed stocks, whether you're looking at growth or whether you're looking at value. But you still need to have some of that qualitative analysis. You can't just say, okay, this stock is the cheapest, on an per earnings basis or on a per sales basis, so this is what I'm going to invest in. No, obviously, you need some of that qualitative analysis first to understand if the stock is cheap for a reason. I mean, a lot of stocks that sold off in October, they might look good on a relative basis against peers, but they've got some real hangups. So you need to do that qualitative analysis to understand whether it can rebound. Just some investing warning signs for value, and I think this is where investors have the most, get in trouble the most. And this is again related to that high dividend yield investing that a lot of people do. People go after a stock that is extremely cheap against its peers. Maybe it's trading for 9 times earnings or 9 times sales versus most of its peers, a peer average of 15 or 20. But you need to know if it's cheap for a reason. And there's 2 things that I always look for in value investing to understand, whether a value stock is a good investment or it's cheap for a reason and there are some fundamental problems. First of all is debt. It might be able to be covering those debt payments, those interest payments, but how is it used debt to fuel the growth in the business, those sales, and what kind of a percentage off sales would bring it into trouble? Debt, you definitely need to look at debt when you're looking at value investments, because that's probably the number one reason stocks get in trouble and ultimately go bankrupt, right? Because their debt is higher than their assets. So first look at debt, but related to that is acquisitions. And I know the acquisition model is very popular right now. Over the last 5 or 10 years, it's been very hard to grow sales just because the sluggishness in the economy. So a lot of companies have turned to that acquisition model, just buying other companies, and of course that props up their sales. But are they really fixing their fundamental problem, or are they just papering over it by buying sales? And so this is related to that problem with debt, because they're bringing on so much debt with these acquisitions, and of course management is always overly enthusiastic about how much more sales they're going to get, and then the savings they're going to get on operating expenses by combining these 2 companies. So you really have to ask yourself, if a company is growing primarily through acquisitions and primarily funding that through debt, then how realistic are those sales and more importantly, the earnings and the savings from the operating expenses. Next, we'll talk about individual retirement accounts, or IRAs, and you don't talk about this a whole lot when you talk about stock investing and that what of investing, but this is probably one of the most important topics that you can talk about when you're trying to reach your financial goals, okay? Because this how of investing, whether it's in a 401k, an IRA, a Roth IRA, that's the best money you're ever going to make. Believe me, as a private wealth manager, when I was managing rich people's money, that's they got all the tax breaks they could, and this is one of the easiest tax breaks you can ever get. Okay, so a 401k, most of you know what a 401k is. It's a company sponsored plan. They're going to match some of your investment into that, which is a huge return. If they're matching 50% of your investment, that's like a 50% return. Nobody gets that. Warren Buffett doesn't get a 50% return. So you need to be maxing out your company match if you have access to a 401k. Next, so that's up to $18,000 a year you can put into a 401k. Most companies aren't going to match that. So most companies are going to match maybe 3 to 5% of your income. So what I'm saying is, invest that 3 to 5% of your income into your 401k. If there's anything left that you can invest it in an IRA, because most of these 401ks, they only allow you to invest in mutual funds, which are extremely expensive. Most of these 401ks have high management fees. So it's not necessarily the best investment, but you just can't beat that company match. So after you invest in your 401k, invest in an IRA, which gives you those immediate tax benefits. All your money is tax-free until you withdraw it in retirement, and just an excellent return. Now, I'd also say everyone needs a Roth IRA. Now, it used to be the thinking was you think about, okay, are my taxes higher now or going to be higher in retirement? Well, what I'm saying is it really doesn't matter. First of all, you don't know what taxes are going to be 20 or 30 years from now. We don't want to know what taxes are going to be a year from now, let alone 20 or 30 years. So it's really hard to say, okay, I want to plan now for what taxes are going to be 2 decades into the future. Second, though, it's just going to give you more, it's just going to help you manage your money easier in retirement, okay? So a regular IRA, a traditional retirement account there, gives you an immediate tax savings. You don't pay taxes on any money you invest in the account up to like $6,000 a year, right? Or it's $5,500. For a Roth IRA, you still have to pay those current income taxes. You pay your income taxes, and you put money in that Roth IRA. But when you take it out in retirement, there's no taxes on it. And what's really cool here is, yeah, you paid taxes on the money you put into that Roth IRA, but you never pay taxes on returns. With a regular IRA, you save on your taxes now, so you don't pay any taxes on the money you invested. But when you take that money out, it's taxed. You tax the deposits that you made plus any returns that you made on that money, right? So a Roth IRA is an excellent excellent option to get even a little bit more tax savings. And then if you've got an IRA and a Roth IRA in retirement, depending on what your income is going to be that year, you take maybe a little bit more out of your Roth and have lower taxes. So it's just a great way to manage that tax bill in retirement. And what you can do, what I would do, because you can only invest so much in an IRA or a Roth IRA each year, right? So you can only invest maybe $5,500 in either or split them up. What you can do though is you can invest all of that in a regular IRA, get that immediate tax benefit, and then every once in a while, every few years, move some of that into a Roth IRA. Now you'll have to pay the income taxes on that amount because you didn't pay them before, but it's a really great way to still max out your IRA, but be able to have some in your Roth IRA as well. And we can get into more of that in the questions and answers or anything like that. Last investment term here is something actually I probably should have put it earlier because it's so important and so frequently neglected by investors. Most investors are stuck in this returns-based investing strategy where they're just picking stocks, reaching for those double-digit returns, and never really understanding that how of investing. They're completely caught up in the what of investing. Now, risk tolerance is one of the most important concepts in that how of investing. And this is really just understanding your investor type, right? Some people are naturally high-strung. Some people are a little bit more aggressive. Stress doesn't stress them out so much. And a lot of that goes into two factors in your investor type, your willingness and your ability. So your ability is really tied to how much you have saved, how much you're able to save, and your retirement goals. And this is really kind of where one of the tragic twists in investing comes from. A lot of people, they haven't saved enough. They're approaching retirement and then they get nervous. They start thinking, well, man, I need to get those double-digit returns. I need to put even more money towards stocks to make up for that lost time. Well, you get to your 50s, and whether you have a portfolio big enough to pay for your retirement or not, you cannot afford to lose it in the next stock market crash. You cannot afford that risk. So ironically, you actually have a lower tolerance for risk. You can't afford to get hit by that next stock market crash. On the other hand, if you've got a sizable portfolio relative to your goals, then you can take a little bit more risk. So it's a little bit ironic, a little bit counterintuitive that if you haven't saved enough and you don't have much time to save for retirement, then you actually need to take less risk rather than more. So that's a lot of what your ability to tolerate risk is, your portfolio size and your age. Okay, now your willingness to tolerate risk is what we usually think about when we talk about it, and that's just how stressed out do you get when you see your portfolio going up and down. A lot of people, just that correction in October last month, people were freaking out about their stocks. I got a lot of comments, a lot of emails from people in the community. What should I do? I'm freaking out here. I'm losing sleep. On the other hand, there are a lot of people that look at it and say, I've got 10, 20, 30 years left to retirement. I'm not going to worry about 10%. I'm not going to worry about a 20 or 30% change because I know the stock market's going to go up and I'm not worried too much about it. So this all feeds into how you actually invest your money. If you're just that naturally a little bit higher strung, you have a lower ability to tolerate risk, then you want to be in more of a conservative portfolio. You want, you can still have a lot in stocks, but you want it in utilities, consumer staples, telecom, things that aren't going to jump around a lot when the when an economic recession comes. Conversely, if you have a higher tolerance for risk, you're a little bit more aggressive, and you don't get stressed out by your stocks, then you can have more in technology, industrials, and financials, things like that. So it's a very important concept that we'll talk about in future videos, and it actually is a big part of the course. So with that, I think I'm going to open it up to questions. I will say, make sure you, if you're coming in after the live stream, just ask any questions within the comments. I always answer all the comments, and I'll get back to you through that. Watch Monday's video. Monday's video is going to be a huge video coming up. That's Monday the 19th. It's the seven strategies that I started investing in real estate with no money. I got out of the Marine Corps in 2001, and I had done well. I had saved up. I worked as a bartender for most of the time while I was in the Marine Corps, and was able to save up some good money, but it still wasn't a fraction of what I needed to get into real estate. And this is the problem that a lot of people have. Real estate's great returns, but it's very hard to make those down payments and buy multiple properties to build a portfolio without $50,000, $60,000, $100,000. So that necessity forced me to look for all the different ways to invest in real estate with no money down. And I put those into an epic video of 7 different ways that you can get started in real estate investing with little or no money. I mean, we're talking, I think, the biggest one is maybe $2,000 or $3,000 that you'll need to start that strategy. But there's 7 strategies to invest in real estate with no money. That's coming out Monday, November 19th. So next Monday. I always post at 10 a.m. Eastern time. So be watching for that, and I'd love to hear your feedback on that. So let's go to comments, questions now. If I missed your questions earlier, just go ahead and ask now. I see new strikes, specifics. Again, I want to thank everybody for joining me here. I know sometimes these run a little bit long, but it's just I just love interacting with the community in a live way, and getting this back and forth. And I appreciate you being subscribed to the community. I appreciate you being in the community. It's a really great feeling to be able to talk back and forth with everybody. Almost 28,000 people right now. So that's fun. I would call T. Okay, what do we got? These types of vehicles. So I don't know what type of vehicle you're talking about here. If you had to pick a single metric, which would be your favorite? Okay, again, these valuation metrics are something that we're going to talk about in the next live stream. But if I had to pick a single metric for all stocks, and again, really what you should be looking for is industry-specific metrics, like those active users for social media, or price to book is good for a lot of financial stocks. But a single metric that I use is that enterprise value to sales. Okay, and again, that's because sales is much less manipulated by companies. They get down to earnings, and they have so many ways to manipulate that up or higher or manage those expectations. But sales is obviously much harder to manipulate. They can still bring some stuff forward or back, but it's much less easily manipulated. And then that enterprise value, it's just a very, very much pure look at how much investors are valuing that company. Okay, so again, you take for the enterprise value, you take the market capitalization, which is the total value of all the shares. It's going to be on any stock investing platform or Yahoo Finance. It says market cap. Take that minus cash on their balance sheet. So, for example, if we have Apple, $1 trillion company, $1 trillion market cap, minus, I think they've got something like 350 billion in cash right now. So minus that's 650 billion. Plus add back all their debt. And I think Apple has somewhere around 260 billion in debt right now. So you've got 650 plus 250, we'll say that's 900 billion enterprise value. Okay, so that's a measure of what investors think this company is worth, as what the whole company is worth, cash, debt, everything, divided by sales. And so what you do with this, what you do with this measure is you compare it against other stocks in that industry, very similar business model companies, okay? And you get an idea for, which one's cheaper, which one's more expensive. This is also going to give you a very good idea of the debt in a company. So if you see a company that looks great as far as it says price to earnings or price to sales, it's got a good balance sheet cash, but then you look and debt is more than the market cap. There's a problem there. There's a problem when debt is higher than the market cap. So yeah, looking at that enterprise value divided by sales or just looking at that enterprise value is going to give you a good idea of that company's balance sheet health. What's the company valued at, what's their cash on the balance sheet, and what's their debt. Okay, so enterprise value to sales. That's a very good one. And then again, a lot of those industry specific measures that you want to look at. Lydia Santiago wants to know, what is EBITDA? Usually you see EBITDA, which is EBITDA, and that's earnings before interest, taxes, depreciation, and amortization. You don't see a whole lot of amortization outside of maybe financial stocks, but EBITDA is just it's a little bit purer look at earnings. So EBITDA is going to be, you got your sales minus your cost of goods, COGS, or sometimes it'll be called just raw materials or gross, right? And then you minus your operating earnings or your operating expenses. And this is obviously, all the things that the company pays to run that day-to-day business within the quarter, okay? And that's going to give you your earnings before interest and taxes, okay? So you'll have your operating earnings, and then you'll have we're talking about the income statement. You have operating earnings, then you take out your interest payments and you take out your taxes, which gives you earnings, right? Well, like I said, earnings is a horrible look at a company's earnings power, right? Because you've got all these weird things that go into it. A company with no interest expense and a company with lots of interest expense are going to have very different earnings. One is very highly leveraged, but they get to take that off of their taxes. So maybe it's a better idea. Looking at EBITDA is better though, because you remove the effects of those earnings or those interest and taxes, right? So you remove the effects of interest. Maybe a company is getting higher earnings because of financial leverage. They've got a lot of debt, so they've got a lot of interest expense. So you take it out before interest and taxes, but before depreciation as well. And so EBITDA is going to be more important for companies with a lot of capital expenses. So we're talking machinery. A lot of industrial companies spend a lot of money on capital. So machinery, factory, plants, that kind of thing. And what they do is they capitalize that, they put that on the balance sheet as an asset, and then they depreciate it. So every quarter, it's like your house depreciation, right? They take that money off of their earnings as a tax benefit, okay? Well, it's not necessarily true earnings or true cash flow, which is why, depreciation is on the cash flow statement as well. So by taking it out of earnings, you get a little bit purer picture of your actual earnings generating power of the company. So that's EBITDA. Roth IRA, BR investing. You're in Europe, right? Did I miss EV sales? What is a good ratio? EV sales, again, with any of these price multiples, whenever you're looking at price to sales, price to earnings, EV to sales, any kind of a valuation multiple, you have to look at within the industry, okay? Because if you're comparing, Bank of America might have a price to earnings of 8, I think. Maybe it's higher. Maybe it's 12 or 15 right now. Comparing that with Facebook, which might have 35 to 1 price to earnings. Well, then obviously, Bank of America must be a much better deal, much cheaper. Well, not necessarily, because stocks in banking, in community banks or the banking industry are just valued much more conservatively. Their growth typically isn't as high as some of these social media sites. So you have to compare these price multiples within an industry, and that's not even within a sector, okay? Because so for example, if you're looking at shit, I hope that didn't just put out our internet, but it's evidently we're getting a thunderstorm here. looking at healthcare, so if you're looking at healthcare companies, the sector, biotech is valued very differently from facilities managers. So you can't necessarily compare two stocks within a sector. All right, you have to compare stocks within their specific industry. Okay, yep. Does technical analysis really work? Now I'm going to make a lot of enemies here and say no. Technical analysis. I mean, if you are a lot of this stuff, trading, day trading, technical analysis, a lot of these trading strategies will work if you're willing to treat them as a job, 9 to 5, 10 hours a day at your computer, doing these strategies and understanding the different strategies. For the vast majority of people, don't even waste your time with technical analysis, okay? Because all technical analysis is watching, watching the price movement of a stock compared to its historical price movement. And everybody's watching this at the same time. Everyone has the same strategies, there's no value added to that. So how do you expect to really make money if you're not analyzing, the fundamentals, what's baked into the stock, and your different outlook for the stock? So there's a lot of people that do make money on technical analysis, but it's generally the people that do it as a job. They're either algorithmic traders or algorithmic trading for a company's portfolio, or they've got traders that sit there and they make arbitrage opportunities by buying and selling very quickly. The higher the EV to sales ratio, the more debt a company has. Not necessarily. I mean, a company could just be valued very, very highly. A company. So going back to that Apple example, we established Apple $1 trillion stock minus the $350 cash plus the $250 in debt, about a $900 billion company, but relatively low debt. So if that 900 divided by what do they do in sales a year? 400 billion, 500, something like a 400 billion. That'd be roughly about 2 to 1 enterprise value to sales. Now, another company, you could have very high debt, which would be, maybe debt, we'll call it a $2 trillion enterprise value. Well, if they've got sales of 1 trillion, it's still only 2 to 1. So it's not necessarily that they have a lot of debt, but you do need to look at that balance sheet, cash and debt, and understand that if a company has more debt than market cap, then that is definitely a sign of some weakness. Dogs of the Dow, reinvesting dividends for 20% of your investments. Sure, there's some strategies like Dogs of the Dow, very stable companies generally. Reinvesting, I would always reinvest dividends. Investing is about the long game. So unless you're living off your investments, then why would you take those? If you're not reinvesting your dividends, then you're missing out on a lot of extra return that you can get. I think, so dividends. Return on dividends, I think it's something like 40% is on the reinvested side historically. Yeah, that was a loud thunder. Okay, so what else do we got? We got any more questions? My voice is getting a little bit. So I will try to. If I didn't get your question answered, then I'll go back and I'll answer them in the comments section on the video. If you're just coming into the video, obviously leave those comments and I will answer them as soon as I see them. Again, I want to thank everybody for joining me. I love this sense of community, this feel that I get just with this back and forth. Something you just don't get in blogging and in other businesses. I had a lot of good time, and be sure to watch for that video Monday, the seven real estate strategies that you can start with no money down. Go back and watch Friday's video if you missed that. Those seven investments and that investment outlook for 2019. Again, this is what I did as a wealth manager and as an equity analyst. Every year, get together, put together an idea of what are those, what's the outlook on those different assets, and put together a pitch for our private wealth clients. What kind of investor are you? I am a very conservative investor, actually, and that's a good question. That's something that a lot of people don't understand about analysts and people in the analyst field. They're generally very conservative, and there's a couple of reasons for that. First is that when you're an equity analyst, you generally can't invest. Well, almost always you can't invest in the stocks you cover because that's a huge conflict of interest. But a lot of times you can't invest in that sector or that industry. So a lot of analysts basically just hold a lot of the passive index funds. And there's another reason for that also, just beyond that regulatory oversight and that conflict of interest. Most analysts are very conservative because their main income is tied to the stock market. When the stock market falls and analysts start getting laid off or their bonuses go down, then you don't want that to be the same time that your portfolio is shrinking as well. So actually a lot of analysts are very conservative. They invest in passive index funds, actually have very high in bonds and in cash at any one point. And for myself specifically also, I run other businesses. I mean, most of my money is in my businesses. And this is something we looked at in a video 2 weeks ago about how to really truly become wealthy. And that survey of 2,500 millionaires and the fact that they might have maybe 20% of their money in stocks. And it's because they're much more conservative in their financial assets, but because their business assets are so volatile. They run their business and they need that cash to make up for those big swings in their business. So good question though. Something I think a lot of people miss with understanding how professional investors, how equity analysts actually invest, and it's very conservative usually. All right, well, I appreciate it again. Thank you everybody for being here. If you got any questions, I'm always available, and just love having you in the community. Thank you.